If you're looking for a high-income investment that could potentially surpass your full-time job earnings, look no further than the Simplified Volatility Premium ETF, SVOL. With its innovative strategy of selling options on volatility futures and a remarkable dividend yield, SVOL stands out as a powerful tool for passive income generation. This ETF not only offers substantial returns, but also employs robust risk management techniques to ensure stability. From its unique investment approach to recent strategic adjustments, SVOL is designed to maximize your income potential. So, how does it perform? And is it safe in the long term? Well, let's see. The SVOL ETF, or Simplified Volatility Premium ETF, is a unique fund introduced to the market on May 12, 2021. It is managed by Simplify Asset Management, a company known for its innovative approach to addressing the challenges of modern investing. The primary goal of SVOL is to provide investment results before fees and expenses. This fund is designed to mitigate extreme volatility while seeking to generate an attractive income stream and diversification benefits. The ETF has a gross expense ratio of 1.16% and offers a monthly distribution yield. As of July 2, 2024, SVOL had total assets of approximately $1.008 billion, with 44,650,000 shares outstanding. The fund's net asset value, NAV, per share was $22.59, with a market price of $22.60. It also features options trading and does not require a Schedule K-1 for tax reporting, making it a convenient choice for many investors. The SVOL ETF is an innovative solution for those seeking to diversify their equity income portfolios while navigating the complexities of a low-yield environment. However, it employs a sophisticated investment strategy designed to navigate the complexities of market volatility while generating income for investors. At its core, the SVOL ETF seeks to provide negative exposure to the CBOE Volatility Index Short-Term Futures Index. This negative exposure is achieved through a short position in VIX futures, which aims to capitalize on the premium often present in these futures contracts. By maintaining this short VIX position, SVOL allows investors to benefit from periods of low volatility, where the value of VIX futures typically declines, thus providing potential gains. In addition to its core short VIX strategy, the SVOL ETF employs an option overlay strategy to enhance income generation. This involves using a modest portion of the fund's assets to buy VIX call options. These call options serve as a hedge against significant spikes in volatility, providing a form of insurance that can mitigate losses when market turbulence increases sharply. The income generated from the short VIX futures position, combined with the protective nature of the call options, creates a balanced approach that seeks to provide steady returns while managing downside risks. The asset allocation within the SVOL ETF is diverse, incorporating a mix of equities, bonds, and derivatives to achieve its investment objectives. This multifaceted approach ensures that the fund is not solely reliant on its volatility strategy, but also benefits from the stability and income potential of traditional asset classes. Among its holdings, the SVOL ETF includes significant allocations to Simplify Volatility Premium K and U.S. Treasury bills. The Treasury bills offer a secure, stable component to the portfolio, contributing to the overall income stream and providing liquidity. The combination of these assets helps to stabilize the portfolio's performance and supports the ETF's income-generating goals. The fund's detailed allocation includes a variety of securities beyond just VIX futures and options. For instance, it holds positions in various exchange-traded funds, ETFs, that track different segments of the bond market, such as the Simplify Aggregate Bond ETF and the Simplify Stable Income ETF. These bond ETFs offer exposure to fixed income securities, adding another layer of diversification. Additionally, the SVOL ETF invests in high-yield corporate bonds and mortgage-backed securities through instruments like the Simplify High Yield Plus Credit ETF and the Simplify MBS ETF. These investments are designed to provide higher returns, although with increased risk, complementing the fund's volatility-focused strategies. The performance analysis is also quite incredible. Its performance reveals its effectiveness in navigating market volatility and generating income for investors. Since its inception on May 12, 2021, the SVOL ETF has demonstrated a robust performance, underscoring its strategic approach to managing volatility and income generation. Historical performance data shows that SVOL has delivered impressive returns over various periods. As of May 31, 2024, the fund's net asset value return for the past year was 19.90%, while its market price return was 19.79%. Since inception, the fund has achieved a cumulative NAV return of 42.15% and a market price return of 41.20%. These figures highlight the fund's ability to generate significant returns even in a relatively short period. One of the key metrics in evaluating the SVOL ETF is its volatility. Given its strategy of maintaining a short position in VIX futures, the fund has experienced lower volatility compared to many other volatility-based investments. The fund's option overlay strategy, which includes the use of VIX call options, has also helped in mitigating extreme volatility, providing a cushion during periods of market turbulence. This combination of strategies ensures that the fund not only captures income from the volatility premium, but also protects against sharp increases in market volatility. There are several factors that have influenced SVOL's performance over time. Market conditions, particularly the level of volatility, have a direct impact on the fund's returns. During periods of low market volatility, the fund's short VIX position tends to perform well, capturing the premium as the VIX futures decline. Conversely, during periods of high volatility, the fund's call options come into play, providing a hedge that mitigates potential losses. This dual approach ensures that the fund can adapt to varying market conditions, maintaining performance stability. Another significant factor is the overall market environment, including interest rates and economic conditions. The current low-yield environment has made traditional income sources less attractive, increasing the appeal of alternative income-generating strategies like those employed by SVOL. The fund's allocation to treasury bills and other fixed income securities also plays a role in its performance, providing a steady income stream that completes the volatility strategy. Moreover, the fund's management and strategic investments have been crucial in maintaining its performance. Simplify asset management's expertise in navigating market complexities and adjusting the fund's exposure based on market conditions has been instrumental in achieving consistent returns. The active management approach allows the fund to respond quickly to changes in market dynamics, optimizing the balance between risk and return. And, by the way, one of the key strengths of SVOL is its regular and substantial dividend distributions. Investors can expect monthly payouts, which adds a level of predictability and reliability to their income stream. Typically, SVOL distributes around 30 cents per share each month, sometimes even reaching up to 32 cents per share. This regular distribution schedule ensures that investors receive a steady flow of income, making it easier for them to plan their finances and meet their cash flow needs. The consistency in dividend payouts underscores the effectiveness of SVOL's strategy and its ability to generate reliable income, even in fluctuating market conditions. When comparing SVOL to other high-income ETFs, its dividend yield is notably superior. For instance, popular ETFs like JEPI and QYLD offer high yields, but they still fall short of SVOL's remarkable 16.08% yield, which at times can bring very high returns, as seen in May. And when combined with capital growth, these returns surpass most people's salaries. JEPI typically offers a yield in the range of 7% to 9%, while QYLD often provides yields around 10%. These yields are attractive, but they pale in comparison to the returns SVOL delivers. This substantial difference highlights SVOL's unique advantage and its potential to generate higher income for its investors. The ability of SVOL to maintain such a high yield is a testament to its innovative approach and robust risk management. By employing a strategy that capitalizes on market volatility while protecting against extreme fluctuations, SVOL can sustain its high income distributions. This balanced approach ensures that the fund not only generates substantial income, but also preserves capital, providing a double benefit for its investors. The careful allocation of assets and the strategic use of options on VIX futures are central to achieving these results. Moreover, SVOL's strategy includes periodic adjustments to its asset allocation to optimize performance. For instance, the fund managers may reduce exposure to more volatile assets during times of anticipated market turbulence, thereby safeguarding the fund's performance and ensuring the continuity of high dividend payouts. This proactive management style is crucial for maintaining the consistency and reliability of SVOL's income distributions. And let's not forget about the AGGH. It plays a significant role in SVOL's portfolio by providing exposure to investment-grade bonds. Let me break down the impact. You see, this ETF invests primarily in U.S. investment-grade bonds and employs option strategies to enhance its yield, aiming to offer a stable and attractive return. Within SVOL's portfolio, AGGH typically constitutes around 20% of the total assets, serving as a key component that influences the fund's overall performance. The performance of AGGH is closely tied to interest rate movements, making it highly sensitive to changes in the rate environment. When interest rates rise, bond prices generally fall, and vice versa. This inverse relationship means that AGGH value tends to decrease when interest rates are on the upward trajectory. For instance, during periods of rising interest rates, such as what we have seen in recent years, AGGH has experienced downward pressure on its price. Conversely, when interest rates were cut or remained low, AGGH performed better, providing higher returns due to the increased bond price. To mitigate this impact, SVOL's fund managers actively adjust the portfolio's allocation based on market conditions. For example, recognizing the potential for sustained higher interest rates, the managers recently reduced SVOL's exposure to AGGH from 20% to 11.98%, reallocating the assets to more stable, short-term fixed income investments. This strategic move aims to decrease the fund's sensitivity to interest rate hikes changes and stabilize its performance. By diversifying away from AGGH and into assets less affected by interest rate fluctuations, SVOL seeks to protect its returns from adverse market conditions. Looking ahead, the future expectations and strategies for SVOL revolve significantly around anticipated changes in interest rate policies. As global economic conditions evolve, central banks, particularly the Federal Reserve, are likely to adjust interest rates to manage inflation and foster economic growth. Currently, there is a growing expectation that interest rates may remain high or even increase further to combat persistent inflation. The scenario presents both challenges and opportunities for SVOL, which must adapt its strategies to navigate the changing landscape effectively. Given the sensitivity of AGGH to interest rate movements, future allocations to this ETF within SVOL's portfolio will likely be closely monitored and adjusted accordingly. If interest rates are expected to remain high, SVOL's fund managers may decide to maintain a reduced exposure to AGGH, as they have done recently. This cautious approach helps to minimize the negative impact of rising rates on the fund's performance. However, should there be clear signals of forthcoming interest rates cuts or a stabilization in the rate environment, the managers might consider increasing the allocation to AGGH once again to capitalize on the potential rally in bond prices. So, what are your thoughts on SVOL ETF and its strategies? Do you think it's a game changer for high-income investments? Comment below, and remember to give this video a thumbs up, subscribe, and turn on the notification bell for more amazing videos.